Thank you all for coming to this panel. I'm Ellen Callahan. I'm the head of SFA's new research platform. So we're very fortunate today to have a panel of experts who will share with us their thoughts on the Secured Overnight Financing Rate, or SOFR, as you all know, which has been widely touted as LIBOR's replacement. But given the volatility in SOFR in 2019, we're also going to take this conversation up a notch by exploring alternative rates and whether the world after LIBOR could be served by many rates, SOFR included, and what that would look like, and whether that would be more suited to specific products or markets. So we're just kind of widen the usual SOFR conversation a little bit by discussing these alternative rates. But before we jump in, I'd like to ask our panelists to introduce themselves, and we can start with Jen and move down the line.
Hi, I'm Jen Emler, and I run funding, capital, and liquidity at Wells Fargo's securities arm, and that includes the repo desk.
Hi, I'm Claire Hall. I'm a partner at DLA Piper and one of the co-chairs of our LIBOR transition practice.
I'm Richard Sandor, the CEO of the American Financial Exchange, which has developed Ameribor, an alternative to LIBOR.
I'm Jeff Sabatera. I run fixed income sales and trading at SMBC Nikko America.
All right, so let's start off with SOFR, which was selected by the Alternative Reference Rates Committee to replace LIBOR. So unlike LIBOR, as you know, it's a market rate that measures the cost of borrowing cash overnight and is collateralized by U.S. Treasuries in the repo market. So I'm just going to do some quick recaps of 2018 before we start our 2019 discussion. So 2018 was a watershed year for this benchmark. The New York Fed published the rate daily in 2018. CME launched the SOFR futures. LCH and CME began clearing SOFR swaps. And then, of course, Fannie issued the first SOFR-based floating rate note back in, I think, October of 2018. And then FASB adopted SOFR for hedging purposes. So at the start of 2019, there were over 130 participants in the SOFR futures market, with $468 billion of outstanding open interest, over $49 billion cleared in SOFR swaps, and SOFR cash issuance had reached $79 billion outstanding, with participation coming mostly from GSEs, but we also saw financial institutions and corporates. So with that in mind, let's look at what happened in 2019. And I think the first place we have to start is the repo market. So Jen, I will turn that over to you.
So really quickly, maybe with a show of hands, how many people are familiar with the Treasury repo markets? Oh, this is going to be harder. I thought nobody would, so you wouldn't know if what I was saying was right or wrong. I traded structured products for like 5 minutes until I realized I couldn't hack it. So all of you guys are infinitely smarter than what it takes to be me or run a repo desk. But the way I think about repo in general is it's just supply and demand, and it's supply and demand for cash and collateral. And when we're talking about SOFR, that collateral is U.S. Treasuries. And so really what you have to do to think about what happened in 2019 is really the lead up to that. So what was happening with collateral in the market? Well, over the last couple of years, we've run higher deficits. And so you've seen public, U.S. Treasury debt has increased. In fact, that held by the public, I think in the last 2 years, has gone up about $2 trillion. So this was going up. We're running higher deficits. The Fed is exiting their QE. And then you also had, so that's kind of the collateral side of it. Basically, there's a lot more collateral out there to fund. And on the cash side, what you see, and this is a regular occurrence, but you see sometimes if there's a large Treasury issuance or something that might take cash out of the markets, you generally see a disruption for a couple of days. You know, this happens mid-month when you have some issuance settlements as well as end of month. And generally, you can kind of see a backup in rates of, say, a couple basis points, maybe 10 basis points, and a little larger around quarter ends. What you saw in September, which is when kind of everybody started honing in on the repo markets and this dynamic, was you saw, you had these like fundamental things that were already happening, but you also saw in about a week's time about $100 billion plus of cash left the markets. And it left the markets because you had corporate tax day, and so a lot of corporations were taking money out of their money market funds to pay their taxes, and you also had Treasury issuing more, and so I think their issuance went up about 50 odd billion in that 1 week period. And on top of that, there was some speculation that there was also a lot of margin calls needing to be met, and so cash was leaving the market for that. If you'll recall, mid-September was when you had the Iran drone attacks on the Saudi oil fields, so you kind of had some energy markets gone awry, and so a lot of things happened, and what you basically saw on September 17th is it all kind of came to a head, and that supply and demand imbalance got off balance. And so what you saw is you essentially saw repo rates rise about, on average, call it 300 basis points overnight, and this was just for the overnight Treasury rate. And that caused a lot of people to kind of hone in on this and this dynamic. Now, what ended up happening, and what we've seen since, is you saw a very swift, a very swift action by the Fed. And essentially what they did was they injected a lot of reserves into the system, and they did this through open market operations. They actually, became a repo counterparty to primary dealers. And so what you've seen since then is you've actually seen this supply and demand imbalance kind of come back to balance. And, if you kind of look, I'd say it's been very successful as the Fed kind of figures out in this new paradigm of a larger balance sheet and how much reserves need to be in the system. They have a lot of different avenues to inject reserves, and one of them being the repo markets. But what we saw over year end, actually after having that kind of blip in mid-September, the Fed, I think, made available about $490 billion in liquidity at year end in the repo markets, of which only about half was actually used. So if anything, they definitely stood ready and willing to supply cash into the market. And then what you saw as a consequence was you saw very little movement. In fact, I think our repo desk was complaining at how boring year end was. You saw a backup in rates of maybe less than 10 basis points, whereas traditionally for year ends you could see 50 basis point backup. So I think that what we learned through all of this was there is this kind of supply-demand balance that SOFR is very dependent on, but also we saw that it can quickly, that dynamic can quickly change, and we've kind of seen it being a very calm repo market since then.
So what do you think are the implications then for 2020? I mean, while I appreciate that the corporate taxes were due and you had a kind of a confluence of all these things, which I think for the most part were expected. I think what was unexpected was the market behavior. So, I mean, do you think that there's enough cushion now in the system that going forward into 2020, we won't see that same kind of volatility? I do think so. We've had some Fed governors on the tape recently talking about, if anything, they're probably going to lessen the use of the repo facility, but there are other things they're going to do, including, potentially encouraging banks to use the discount window and post treasuries. One thing that you've also had happening really since the crisis is you've had this kind of regulatory and really supervisory frictions, whereas before when there was this supply-demand imbalance, what would happen is you would see banks lend out their excess reserves into the repo market. You would see primary dealers kind of really be that transition mechanism between the Fed and the end user. So for example, if you have my institution, Wells Fargo, in the middle as a dealer, we have access to money funds and that want to fund Wells Fargo securities, and then we have REITs on the other hand that want funding, and we would kind of play that transition mechanism role. And what you saw with the crisis is you saw a lot of regulation come out of that, and you saw banks less willing to lend because they wanted to keep cash on hand. And then you also saw dealers less willing to provide the intermediary service. And I think that what I've honed in on some of this Fed speak of late is they're maybe going to try to kind of lessen some of those supervisory frictions, definitely encouraging banks to potentially participate in the Treasury repo market more, knowing that you can post those securities to the Fed for cash. Because, from a liquidity standpoint for banks, cash has been king since the crisis.
And I think now they're looking at alternate ways other than just a repo system to inject reserves, into the system and really inject liquidity into the system. And so I think that they're kind of figuring out that supply-demand, balance and what's appropriate. And I think we are seeing the swift action from the Fed, and I have no reason to think that they're not going to continue to do their job, which is to make sure they can manage the money markets.
Jeff, did you want to add anything to this, given your role and kind of what you've been seeing in the market?
Sure. I think, Jen summed it up very well. I think all the important points were covered thoroughly. The one thing that I would emphasize is that for the repo market and by extension for SOFR to have credibility, it's going to be important that there's a perception of market stability. Now, a spike in rates is, actually good for investors. Your coupon goes up, not so good for issuers. But I think in the end, the uncertainty and disruption probably is not great for the market. So I think one thing that happened on September 17th, although I haven't seen a lot of clarity on this, is that there was supposed to be some intervention very early in the day that was not executed. So I think it had been 10 years since the Fed had intervened in the repo market. I think the head of market operations had resigned. So I think if they're going to maintain stability, they need to make sure that all their tools are working properly, as they tell us regularly.
That just added to the
Sure.
fun.
Yeah, it was definitely a wild ride, no question. So I think, things like that are going to be important, but, as Jen also mentioned, year-end was extremely stable. The rate's been very stable, and, as we can, when we start to talk about SOFR a little bit later, we can see what impact that's had on the acceptance and, the issuance of SOFR as well.
So then maybe at this point, we'll move over to cash issuance. So SOFR-linked debt outstanding is now over $300 billion. And I think earlier I had said that it was $79 billion at the end of 2018. And like I said, GSEs have dominated issuance. So we've seen a few things. So the Bank of China issued the first SOFR-based bond outside of the U.S. last year. But we also saw corporates issuing right after the repo market dislocation. So there's been a lot of, positive notes around it. But then there was recent news that the Federal Home Loan Bank kind of pulled back issuance in the first month of 2020. So it's, these are all kind of it contradicts what we have been seeing in terms of, at least on the face, it contradicts what we've been seeing in terms of cash issuance. Maybe it doesn't. Maybe if there's something more about that you could talk about, that would be great.
Sure. I mean, I think the fact is, a market is formed by an agreement between buyers and sellers. So issuance goes up, issuance goes down. I think there are two sides to the equation. And, it was interesting to look at the relationship between LIBOR and SOFR for the 6 months leading up to August. So leave September out, that was highly volatile. So 6 months leading up to August, the spread between 1 month LIBOR and SOFR was flat. And I think 1 month LIBOR is probably the rate to look at because that's what most of the LIBOR floaters from the Federal Home Loan Bank are based on. So flat to 6 months ending in August. So skip September, a lot of intervention by the Fed, stability in the market, et cetera. So from October until now, the spread between SOFR and 1 month LIBOR has been minus 10 basis points. So SOFR is 10 basis points tighter. Now, the other factor to look at in terms of bond issuance, in addition to the spread between the indices, is the spread that the issuer pays on top of the indices. So essentially, the home loan banks, prior to the 6 months leading up to August, they were paying an additional 6 basis points for SOFR issuance versus LIBOR issuance. So basically, since LIBOR and SOFR were flat, an investor was getting 6 basis points more for buying a SOFR bond. So yeah, that's a nice incentive, for an index that is new, operationally complicated, et cetera, 6 basis points, maybe that's worthwhile, and so there was a lot of issuance. So again, skip September, post-October, that spread has gone up to 9 basis points. So the index relationship went to -10. The issuer is paying an additional 3 basis points. So that's basically, a 7 basis point deficit. So instead of investors getting plus 6 basis points for buying a SOFR floater relative to LIBOR floater, now since October they've been getting -1 basis point. So, that's not so exciting as an investor, but, again, there are two sides to it. From the issuer's point of view, it's not clear exactly how they're measuring SOFR versus LIBOR for internal purposes. So, for instance, I know one treasurer of a very large institution that issues, quite a bit of fixed and floating paper who has done a SOFR issuance, and internally for their purposes, they're not treating SOFR any differently from LIBOR. They track the basis as the Federal Home Loan Bank does, and apparently that LIBOR SOFR basis on their own balance sheet is now $35 billion because their assets are LIBOR-based. So the home loans are LIBOR-based. Now they're issuing SOFR liabilities, so that is a mismatch. There's a basis market. It's in the teens right now. You can price that in or do some kind of accounting math to account for it, but certainly I know a number of entities are not doing that. And so that's something to keep track of. But going back to what affected the issuance, essentially, from the issuer's point of view, if they had been treating SOFR the same as 1-month LIBOR, which it had been, then from their point of view, they were paying an extra 3 basis points. So, they were adding something, but from the investor's point of view, they were getting 7 basis points less. So I think that probably, contributed to a decline in issuance overall. I think that's one observation you can make. Yeah.
So a market-driven event, and it speaks less to, I guess, confidence around SOFR as more, it's just a competitive benchmark
Well, it's
now.
economics, and I think there was a number of articles from investors saying that they're looking their obligation, they're fiduciaries, so they need the highest return, and I think that's what they're going to gravitate to. So if SOFR is worth their while, they'll buy it. They had in the past. If it's not, they won't. There are other types of instruments. But clearly the world is migrating to SOFR. I think there were also some recent articles about how Fannie Freddie, the mortgage banks now are going to transition their mortgage loans from LIBOR-based to SOFR-based. So that's going to cut down on the SOFR basis problem. And that is significant. So, let's say you're in a financial institution that has a $10 billion SOFR basis. Every basis point move, that's, if it's an average of 5-year duration, that's, $4 million for 1 basis point. And as we saw between August and October, that moved 10 basis points. So, it starts to become real money. Yeah.
Richard, did you want to add anything to this?
No, I feel that my two fellow members of the panel really summed it up perfectly. I think the drama around SOFR and its volatility is over. IOER is at 160, and the Fed does repos at 160. So when you have the government buying and selling, it's hard to imagine a duplication of the events that occurred in September.
Well, that's great to hear.
Or not if you like
It's true, that's right,
opportunity that comes from the
right.
volatility.
But we'll move on to, I guess, the other event in 2019. And Claire, maybe you would like to bring some attention to that?
Yeah, absolutely. Thank you. I think what we saw in 2019 was the market start to embrace SOFR. We certainly didn't get like a full wholesale adoption of it as the replacement rate. Regulators started pushing for people to really consider SOFR. We saw, as you mentioned, $300 billion of cash products now. We saw the first SOFR loans. We saw futures and options products linked to SOFR. Trading in those increase, and trading generally in the notional amount of interest rate derivatives linked to SOFR all increased over during 2019. But what we didn't see was like a wholesale adoption by the market or an embracing of SOFR as the replacement rate. And I think there's still a question mark in many people's minds as to whether SOFR is the replacement rate. if you compare what's going on in the US, say, to what's going on in the UK, where the regulators have been very forceful about stopping the practice of issuing LIBOR loans, LIBOR paper. That market has really moved away from LIBOR, whereas we just haven't seen the equivalent here in the US. So I think that there was some good progress last year and certainly through the beginning of this year. And it's great to see that people are issuing products, SOFR derivatives, because obviously that is necessary to underpin the rate and build confidence. But the market hasn't shifted entirely. I think we saw some really good work from industry groups such as ISDA and the LSTA coming out with documentation to support not only changes from legacy products to the rate when LIBOR goes away, but also to help support the issuing of new products. So I think a lot of progress was made, but I still feel that there's quite a long way to go. I don't know I'm seeing it more from a legal perspective. It would be interesting to see what people, from a trading or the business perspective think.
So I guess maybe that's a good kind of question to ask is, what did you hope to see in 2019, but you didn't? And, what did you hope to, where did you hope to be at this point of the transition?
In some ways, that's probably more a question for someone who's kind of in the trenches of trading or issuing paper. I think as lawyers, we always like certainty, and our clients like certainty. So, and I think that while progress was made on that, we didn't, there's still a lot of unanswered questions. What's going on with ISDA is a good example. They at this point thought that there would be a protocol out there. I know that's more to do with legacy products, but I think it's kind of representative of the fact that there's still uncertainty in the market because the protocol hasn't been issued yet. They're still in consultation phase. There's still a lot of consultations going on generally in the market. So I think maybe looking back this time last year, we're probably not as far along the timetable as perhaps I expected us to be. But I say looking at it more from a legal perspective.
Jen, did you want to add to that?
Look, I think that there were some necessary growing pains in the market in 2019, and I think we've all learned a lot more about SOFR, how it behaves, and repo markets in general. So in that sense, I think it was kind of like a necessary evil to get us to where we are now, and including the Fed, to Jeff's point, learning how to kind of think about the corridor that they need to manage there. And so I think that was all, like a necessary growing pain that was going to have to happen at some point. I think, Claire, you hit on a really important point, which is just kind of developing those protocols and what you do for the legacy agreements. Mm-hmm. It kind of feels like from where I'm sitting and what I'm reading, and Jeff, I don't know if this is how you feel, but it's almost like everybody's like afraid to be like just like the moving forward part. And it's like somebody's just got to figure it out, and right or wrong, you just gotta barrel forward. But I feel like there's some hesitancy. But everything like it's going away in 2021. So I'm kind of sitting here wondering well, what's going to happen? Is there going to be something magical that's going to happen in the next month, 6 months, 1 year?
I imagine probably more regulatory pressure. I think, as I said, what happened in the UK where essentially, issuers were told to stop issuing LIBOR-linked paper. Mm-hmm. So that obviously drove the switch there much faster. I think coming up this year, the likes of the LSTA pushing the development of SOFR very hard. In the loan market, you've got ISDA obviously working on the protocols. When their consultation ends, a reconsultation on the pre-cessation triggers. Hopefully we'll have more clarity about the timeline for derivatives and what will happen both with legacy trades and then updating the definitions for new trades. So, as you said, I think there was growing pains. I think the timetable has perhaps been pushed back a little, but we're making constant forward progress. But I agree with you. I think there's a lot of people who are still somewhat reticent to go all in with SOFR, and that might be the right approach. SOFR might not be the right rate for every situation.
But at some point, I feel like somebody has to go all in, right? I feel like, so this year, there have been 2 new developments so far. The Fed's going to publish the 30, 60, 90, and 180-day SOFR averages, and FHFA announced additional steps that Fannie and Freddie are taking in the transition away from LIBOR. So maybe, Jeff, could you speak a little bit about what you think those two developments, the implications for the 2020 market?
Sure. So, we touched on the mortgage loans being based on SOFR in the future as opposed to LIBOR. That'll be significant since it'll cut down on the asset liability mismatch to the big home loan banks who are large issuers. So, hopefully they'll be able to incorporate that into their issuance. And, I think investors are going to want a fair level, as they always do. And, so I think that will assist in that process. Another development that, hasn't been mentioned is Treasury, the U.S. Treasury potentially issuing SOFR floaters. So I learned this morning that the Treasury actually does have a floater that's based on bills, an old one, I guess, not very many. But if the issuance by the government of SOFR instruments increases, then that'll certainly, I think, make people more comfortable with it. Also, the CME is going to start to require discounting be done on SOFR basis. That's going to happen from this summer. So again, another mechanism to kind of incorporate SOFR into the financial system. And, ultimately, if there's a mismatch, then, those are going to have to be managed or, borne outright. And I think, for the large mismatches, those are going to be P&L events. So everybody's going to be incentivized to manage their assets and liabilities in a prudent way. Just looking at SOFR LIBOR swaps today, the bid offer in just kind of 5 and 10 years about 1.5 basis points. So, if you have to cross that again for, $10 billion, $10 billion, say, that's, a few $1 million right there. And for, regular 5 and 10 year swaps, it's about 0.5 basis point. So I think, as the discounting takes hold, as a number of these mechanisms start to develop, the cost of managing the basis itself is going to start to diminish. The cost of managing it will diminish. And, it's not, there was talk about a big bang. I guess maybe this, the CME and the LCH discounting this summer, that's been described as a big bang. And I think, that would be the case. I think there are also some other basic issues that people are going to have to get used to, like calculating accrued interest. So, we were talking earlier about how to do that, and, I have a standing offer of, 1 beer for anybody who can explain to me on a Bloomberg screen how to calculate SOFR accrued. So I tried it, for grins earlier this week, and it was not straightforward. And I reached out to Bloomberg. I said, what am I missing? I didn't hear back. So, I haven't been able to do that myself. And so, for LIBOR, obviously, it's pretty straightforward. The rate is set 2 days before the calculation period, number of days, it all ties out. SOFR is not that easy. So, and also the fact that it sets in arrears. So, even for people that take out ARMs to buy their homes, they're used to knowing what their interest rate is 2 days before the calculation period starts. Now they're not going to know until the end of the calculation. I mean, it's not the end of the world. There are derivatives now that you can, trade or, get a structured note that sets in arrears. I mean, it can be done. It's not that difficult. It's just going to take some getting used to. And I think aside from the big bang, all these different factors are going to contribute to SOFR creeping into our lives, and hopefully it's smooth, and we're all better off as a result.
So let's focus a little bit on, the shortcomings. So you mentioned a few. I know that SOFR is supported by a deep market, but I do think that there are kind of inherent shortcomings which have yet to be addressed. And I think one of the biggest ones is that it lacks a credit component. I think because of that, and because it seems that we keep coming back to there is some reticence in this market. I feel like at this point, we should open up the conversation to what does a market look like with more than one benchmark? What would that look like? And I do have to ask, how did we end up with LIBOR as like the only one rate? I mean, what? So I'm going. you can kind of give us your take on this, but it's. It seems to me we're trying to replace one LIBOR with one SOFR, right? I mean, is that Is that the way it should be, or should it be one LIBOR is replaced by different benchmarks?
LIBOR is an anomaly. It was a group of European banks in the 60s that wanted to lend money to the Shah of Iran, and they went in to the Shah and they said, let's have it be not a fixed interest rate, but a floating interest rate. And the story goes, they walked out of the room, the Shah agreed, and then they looked at each other and said, how are we going to reset it? And they decided, in the good old-fashioned LIBOR tradition, they just call each other, and that would be the way it would be solved. And they would collectively determine what the rate was. So it's a historical accident. And it was fed by the launch of Eurodollar futures in '82, the birth of a swap market. The Euro futures were not supposed to go out. They weren't supposed to replace Treasury bill futures, but you had a series of confluence of events. I said to Jen, so I'm 700 years old, and she said, I don't look a year over 300. So having been involved in that, I want to just quickly tell you a tale of how these markets emerge. How do they come about? Under the hypothesis that LIBOR is unambiguously a single benchmark which the world lived with for 40-odd years. In no other asset class do you have a single benchmark. Crude, there's WTI, there's Brent, there's Dubai, there's Shanghai. In the equity markets, you've got S&P, Dow, NASDAQ, Value Line, Russell. And fixed income, it's the same. You actually have more stock indexes than you have stocks. So why should one think that LIBOR or benchmark will be unique and will have no other competitors? So we're professional inventors. We get it wrong a lot, and once in a while we got it right. And in 2011, we read in the newspaper that the Royal Bank of Scotland fired 4 people for manipulating LIBOR. You don't have to be a genius to figure out it takes 2 to collude. So if one bank did it, maybe there were 2, and if you took a binomial expansion, if there were 2, there were 4, 8, and 16, and therefore the entire LIBOR panel would not be. So we called a team in together and said, we're going to do something. At this time, recall, ARC didn't exist, SOFR wasn't a dream, and we said, okay, let's design a benchmark under 3 premises. 1, LIBOR loses its preeminence. Number 2, peculiar. London had LIBOR, Europe had Euribor, Hong Kong even had HIBOR. How could it be that the world's largest economy didn't have its own benchmark? Called up the patent lawyers, filed a patent, trademarked Ameribor, got on a plane, visited. I used to, in my previous exchange, go to London, Paris, Singapore, and Shanghai, and now I find myself in Tupelo, Mississippi, Bentonville, Arkansas, San Antonio, Texas, and for 2 years went around and said to people, let's do it bottom up, and let's get a benchmark that reflects your cost of borrowing, what your credit needs, so that you can structure assets that perfectly match your borrowing costs. And ALCO, or asset liability management, will disappear for you. There's 18,000 banks in America. 10 to 15 control 9 trillion, and we decided we go after the 5,364 non-SIFI banks. We got a little wind in our sails in 14, and went down to the Fed and briefed them in 15, partnered because we're a virtual exchange, and we have an interbank lending market, interbank, and non-financials that lend and borrow overnight on an unsecured basis with each other. We had 4 banks when we started. The biggest bank in Wisconsin, Associated, Frost Bank in Texas, MB in Chicago, and Old National, biggest bank in Indiana. We did 13 million a day. We're up to 181 members, 139 banks, 15 correspondents, so 30% of America's banks trade on the platform by number, and 14%, 2.5 trillion in assets. They range from Fifth Third, Key, Regions, Signature in New York, City National in LA, Associated in Wisconsin, Frost in Texas. The weighted average of that is called Ameribor. It's basically very, very simple. And we wanted to be the anti-LIBOR. Everything that LIBOR has, we didn't want to have. So it's a central market, it's all transaction-based, it's regulated, and we publish a tape daily. The issue is when you build a market, we figured it would take a decade and $30 to $50 million to do it. Mark the beginning at 2012, so call it 2022. Is when, if it follows bond futures or Eurodollars or the birth of Ginnie Maes in 1970, it's about right. It's a decade. 0 to 2 is toddlers, 2 to 5 is middle school, 5 to 10 is young adulthood, 10 to 20 is maturity. If you look at most new financial innovations in the last 50-odd years. We don't worry much about compounding in arrears, okay? We are getting our banks that are now issuing floating rate loans to commercial and industrial participants, and they're doing a 30-day average of Ameribor, period. Because that's what the customers understand. It has a 99.8% correlation with LIBOR, so you can show it. And most of those banks don't have the technology to do compounding in arrears, and they'd rather not because it's 30-day loans. The customers like it. They don't have to do any back office work. This week, we're going to announce the first 1 year with a 30-day reset to Ameribor. It'll come out Friday. We've expanded the membership to non-banks, so they include Northwestern Mutual as an insurance company. Today, actually, this day, Guggenheim joined as a money manager, John Deere as a corporate, Jefferies as a broker-dealer. So we think that competition and choice, and I'm a student of economics, and from Adam Smith to the present, or from the birth of finance in '63 with the famous Markowitz paper, we only know 2 things in finance. 2. That's the sum total of tens of thousands of paper. And those 2 things is, other things being equal, diversification is good.
So,
nobody will argue. And number 2, choice in a marketplace is good. So you get most economists, and we're saying, let it rip. You know, we're IOSCO certified. We went to FASB. And they now accept accounting from floating to fixed. We're going to have loan issuance, discount issuances, and let this index, SOFR, we think is around to stay because of the sponsors. And we hope to be one of the other choices that those people want a credit component. That there were people, and we all know in this audience what happened in 07, 08, and actually could happen in the next 6 months with the terrible coronavirus. If there's a flush or rush to quality, credit will become very different than the stable things that Jeff talked about. And maybe we go back to a TED spread where they move out 40, 60, 80, or in the 80s, 400. So
I'm just going to have to cut you off here, though, because we're going to open up the floor to questions. That was a
shameless promotion. I apologize.
At least
Shameless.
we know what we're dealing with here. We're good. Okay, so
I think we've just discovered the biggest risk to SOFR adoption.
Yes.
there you go. So there could be room for SOFR and Ameribor, right? But I do want to end it before we open up the floor to questions. Is by the end of 2020, what would demonstrate to you that SOFR adoption is continuing to move as the replacement rate for LIBOR, whether a singular replacement rate or
multiple.
Part of a. I'm opening that part up now. So what would be the light for you that you would say, okay, this is what's going to happen?
Well, look, I think that given the, as Richard talked about, or Doc talked about, given the work of ARC, I do think that SOFR will be kind of like the preeminent replacement to LIBOR, and it hit, if you read the white paper, the ARC white paper, it hits all those, it's an observable, tradable market. I mean, you have $1.5 trillion plus trading daily. So I do think that will probably be the official first wave, but I certainly don't think it means it's going to cure all ails for everyone who needs to, issue debt and or price debt, because it's certainly not everybody's cost of funds. I mean, it's the cost of funds of the U.S. Treasury, really, if you think about it.
Claire?
Yeah, no, I agree with you, and I think there's some issues with SOFR that we've talked about that hopefully will be addressed. I'm not sure that all of them are addressable. One of the things we've talked about specifically is the lack of a credit component, and I think that's one of the biggest problems it has, and also the lack of it being a term rate. And I know people are hopeful that will develop in the future, but the market needs to be more robust, and needs to be more trading generally, and definitely a much more robust derivatives and futures market for that to happen. So. But I agree with you. I think that people are shifting, and I think it will likely be the preeminent rate, but I definitely think there's room for other alternatives.
Richard?
I would agree with both of those comments. Number one, I having lived through Y2K and all of the anxiety and the pain, and the world is going to stop, and hospitals and kids will go unattended, and the time clock would put us into a nuclear kind of inversion. It came and it went, okay? And all of this hand-wringing about SOFR, will it be ready on day one? Will the train station be there when the train gets there?
Will we be able to calculate it?
Will we be able to calculate it? People, I have taught at the university level for quite some time, and it's always amazing to me that the students seem to learn the most the week before the finals. And I think this is what's going to happen. We're going to get real smart as the final exams come, and we'll get ready, and it will come, and it will go. And like Chairman Mao said, there'll be 1,000 flowers blooming. So that's my take on it.
Jeff, would you like to add to that?
I would love to. Yeah, and, I think we've talked about the shortcomings of SOFR. Those are not insignificant, especially for the 5,400 odd non-SIFI banks. So, that point is well taken. My own personal view is that the lack of a credit component is not such a big issue. And the reason for that is if you look at the corporate bond market, for instance, $1 trillion issued every year, 20 billion odd traded every day. Those trade against treasuries. And, a reasonable fraction of those are traded actually as crosses, with treasuries being traded simultaneously against active benchmarks. We talked about the bid offer of term swap rates. So, in cash govies, the on the run, 5 and 10 year, if you convert it to basis points, quarter basis point market, the futures are less. So, as the numbers become large and the transaction volumes are large, there's nothing more important than liquidity. So, it's already there in the riskless markets, and Fed funds is of course highly liquid, and close to, say, $1 trillion outstanding, and hundreds of billions trade every day. It is just an overnight market. Everything else is being derived, so it's imperfect, but it certainly is virtually impossible to manipulate. So the issues that caused the collapse of LIBOR certainly are not going to be the ones that take down SOFR if it does get taken down. So I think since there is such a large, robust and active corporate credit market that really is fundamentally just about credit, that trades against government bonds, I don't see why the floating rate market can't operate in the same way. So, weaker issuers are going to trade at wider spreads. The stronger ones are going to trade at tighter spreads versus governments. Which is what the Fed funds and the SOFR rate is, but they're going to be priced to a risk-free rate. And so, I've been involved in LIBOR for close to 30 years now myself, and I remember for a number of years it was referred to as a risk-free rate. So there really wasn't any concept of credit risk in LIBOR, for a long time, probably till the crisis for the most part. So I think that was, a fairly new phenomenon in the existence of LIBOR just, in the last 10 years. And, it was always considered to be, basically sort of the riskless rate, the interbank lending rate. And, obviously people knew that, that market was diminishing and, wholesale funding was, there were a lot of transitions that were happening, but it was generally referred to as a risk-free rate. So I think now, there is going to be, a very clearly a risk-free rate that is liquid and active. It has issues, but I don't see the lack of a credit spread in an index as an inhibiting factor.
All right. So I think we have time for one question. As long as it's not to Richard. No, just
Whoa! How long do we have the room?
Whoa. Sorry, I had to do that. Okay. So if there is one question, otherwise we're going to let this go.
Richard did a
One question?
great job explaining. There's no need for,
Okay, so I think that's great. Well, thank you all for attending, and enjoy the rest of the conference.
Thanks.